We're going to get right fired up with some news you can use. We're going to do it in two parts. Everybody by now is aware that markets all over the country are starting to crash in terms of home prices and things like that, with very few exceptions. That's a general rule across the country. Last week on Thursday, we talked about, you can go back and look at the YouTube channel. You can see where Ben Bernanke, the former chairman of the Fed, said, yes, we are, it's no doubt, we are definitely in stagflation territory, and it's going to hit full blown by the end of the year. Everybody, it seems, except for Zillow and the National Association of Realtors, has recognized this, and we're going to talk about the latest one that has drank the Kool-Aid after this short video. I'm going to watch a video because a lot of people are saying, was this going to be like 2008? And there was a movie that came out in 2011 called Too Big to Fail. It's a great movie made by HBO, has a lot of stars that you'll know. There's a 3-minute clip that we're going to play here in a second that describes what happened to the housing market in 2008-9. Actually, it was 2007 and 8. And they do such a great job. I couldn't explain it as well as these guys can. So without further ado, actually, let's go ahead and put that video on. When we're done, we're going to talk about the headline article from Fortune magazine.
I hate to do this right now, but I'm going to have a press call first thing, and I really don't know what I'm going to tell them.
Tell them Lehman exacerbated AIG. The simultaneous payouts of CDOs and credit default swaps put catastrophic pressure.
Go back further.
The global pool of investment capital.
She has to do this in English. Start with the homeowners.
Okay, here's how you explain it. Wall Street started bundling home loans together, mortgage-backed securities, and selling slices of those bundles to investors. And they were making big money. So they started pushing the lenders, saying, come on, we need more loans.
The lenders had already given loans to borrowers with good credit, so they go bottom feeding. They lower their criteria.
Before, you needed a credit score of 620 and a down payment of 20%. Now they'll settle for 500, no money down.
And the buyer, the regular guy on the street, assumes that the experts know what they're doing. He's saying to himself, if the bank's willing to loan me money, I must be able to afford it. So he reaches for the American dream. He buys that house.
The banks knew securities based on shitbag mortgages were risky.
You'll work on shitbag.
So to control their downside, the banks started buying a kind of insurance. If mortgages default, insurance company pays. Default swap. The banks insure their potential losses to move the risk off their books so they can invest more, make more money.
Well, a lot of companies insured this stuff. One was dumb enough to take on an almost unbelievable amount of risk.
AIG.
And you'll work on dumb.
And when they ask me why they did that?
Fees.
Hundreds of millions in fees.
Yeah, she figured the housing market would just keep going up. But then the unexpected happens.
Housing prices go down.
Poor bastard who bought his dream house. The teaser rate on his mortgage runs out. His payments go up. He defaults.
Mortgage-backed securities tank. AIG has to pay off the swaps. All of them, all over the world, at the same time.
AIG can't pay. AIG goes under. Every bank they insure books massive losses on the same day. And then they all go under. It all comes down.
The whole financial system? And what do I say when they ask me why it wasn't regulated?
No one wanted to. They were making too much money.
You'll work on, we were making too much money.
Thank you, Ashley. Okay, so that was a docudrama piece. That was the Secretary of the Treasury, Hank Paulson, and his staff. She was the public relations person, and they literally had that conversation, maybe not verbatim, but they had that conversation so that they could go out and explain to the public what happened in 2008. There's two pieces of this. The first piece is that housing prices went up and then they went down. The second is that there was a lot of people who got loans that weren't qualified to have loans, that when the interest rates went up, they would lose their house. So, you know, it's a chicken and egg syndrome. Did housing prices go down because there was too many non-qualified borrowers who had borrowed money and the banks had lent ad nauseum to anybody who could find? The old joke was you could fog a mirror, you could get a deal. It was well-known industry knowledge, common knowledge, that there was a lot of fraud involved on behalf of the mortgage companies, putting people into homes that they couldn't afford. In a lot of cases, it was all phantom. It was nothing, because they were pushing money out the door. And as these guys said, you know, why didn't we want to regulate? Because we were making too much money. We didn't want to regulate. They made too much money. And that's exactly what happened. Now, today, so then what happens? It collapses because housing prices go down. That's the first thing that causes the housing economy to go down. It's not bad mortgages going into the system. It's not, you know, World War III. It's none of that stuff. It is prices of houses start dropping. There's a lot of reasons for that. We'll talk about that on Thursday night's call. But needless to say, we're seeing that today. We're seeing housing prices starting to drop. So today is different, however. And the big thing that's different is we didn't write, as they called it in the movie, shitbag mortgages. We haven't done that since 2008. The government has done a good job, and particularly the private sector, these banks that are considered too big to fail, Bank of America, Wells Fargo, New York State, all of these different banks like this, Chase, they've all gotten together at the behest of the government, and they said, listen, we've got to have higher standards to put people into mortgages. And they've stuck with that. So like they talked about in that clip, you know, back in the day, used to have a 640 credit score and 20% down. Well, that's how it's been for the last 10, 12 years. You had to have a decent credit score and you had to have money down. We have not, as an industry, gone to what they call the shitbag mortgages again, which was 500 credit score, no money down, fortunately. So the borrowers are capable of making the payments that they have paid for. However, by putting these more stringent conditions, by actually asking people to verify that they've got 20% down, to, you know, to make sure that they've got a good job, you know, to make sure they can handle the payments, all that kind of stuff, we have slightly constrained the number of buyers out there. In other words, the number of buyers going through the funnel is an accurate number. So when buyers hesitate and they back off and say, we can't afford it, that's a real thing now. It's not artificially inflated like it was in 2008. There's no shenanigans, no games going on. So when buyers today say, listen, we can't afford a house payment, it's real. They can't afford it. And the only thing that can happen is housing prices will go down. All right, let's put this headline article for Fortune that came out, I think, Friday. And then I'll go through this real briefly. This was, I'm sorry, it was in, yes, it was in Fortune magazine. And the headline says, the housing market just slid into full-blown correction, says top economist Mark Zandi. Zandi, this guy is a rock star. This guy's been around forever. He is Moody's chief economist in the housing market. And so this guy, as far as I remember, he'd been through the last recession, the 2008, all that kind of stuff. He's seen all this stuff. And so far, although Moody's is not on the front edge of the tip of the spear, they're right behind it in terms of being accurate, correct predictions, that kind of thing. So what he goes on to say, and let me read part of the article too. He said, Moody's Analytics chief economist Mark Zandi is ready to call it. He tells Fortune that we've officially moved from a housing boom into a housing correction. That's literally what he called it. The real estate data rolling in for April, May shows the U.S. housing market is softening. The drop-off is not a result of seasonality or a soft month or two, says Zandi. It's a trajectory flip. Demand is pulling back fast in the face of mortgage rates that have spiked dramatically. The housing market has peaked. Everything points to a rolling over of the housing market, Zandi says. In terms of home sales, they're falling sharply. Housing demand is coming down fast. Home price growth will go flat here pretty quickly. We will see home price declines in a significant number of markets. All right, thanks, Ashley. And that's the long and short of it. When Moody's now finally calls it, they're considered the best analytics out there. This is not Zillow or National Association of Realtors. Moody's doesn't have a dog in the fight. They're just looking over everything on the economy, not just housing, but all of the general economy. And what they're seeing is probably the most accurate reflection. So he's saying price declines in a significant number of markets. We're seeing that across the country. There are still a couple of handfuls of markets where there is a big demand and not enough supply, and people are still willing to pay a higher mortgage rate. And we're getting close to 6% now, even though it dropped a little bit last week. But generally, it's in the 5.5% to 6% range for a first-time home buyer with 20% down. People are still willing to pay that in a few markets where the cost of the house is cheap. There's a big inequity between the price of the house, or I don't know if it's inequity is the right word for it. There's a big discrepancy in certain parts of the country where a good medium price house is significantly less than other parts of the country where it's quite a bit more. And the interesting thing is a lot of times the income in those two areas are the same. So for example, and we're going to talk about this on Thursday, Tennessee's average home price is less than half of what California, but the income is like 90% of what California's average income is. So it's a lot better place to buy, and you can afford to get more, even at a higher interest rate, in a place like Tennessee, for example. And we're going to show a map this Thursday night that will discuss all of this, and we'll show you what the various states are, which ones are overpriced, which ones are underpriced. And COVID had gotten a lot of people to move, to get up and move from living in the city to living in more rural areas. And since then, people have used it as an excuse to move out of areas like California and to move into more affordable states, or in the case of a lot of Californians, to move into a more red state, versus California, dark blue state. So, and you're seeing more and more of that, and that actually is increasing at a faster clip. California for the last 2 years lost population, first time ever since 1851, where we actually reduced our population. So you're going to see more and more of that, and you're going to see housing prices in some of these unique areas either level off or continue to trickle up a little bit, only because the demand is there. And the demand is this artificial shifting of demographics demand. Every place else across the country, it's going to drop. All right, that is news you can use for today, the 31st of May, 2022.